You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, Jonathan McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Pershing Square, British Land, Luceco, Pets at Home, AJ Bell, and our US company for the week is Nvidia. Sam, what should we start with?
Should we start with Pershing Square?
Okay. Do you want to go ahead with that one?
Yeah, so Pershing Square, it's UK listed. For anyone who doesn't know, it's basically Bill Ackman, his investing fund. So really, it's a US company in disguise. So it's listed on the FTSE. Bill Ackman, by the way, for anyone who doesn't know, is a very, very prominent investor, very well known, and he uses it as his investment vehicle. So if you want Bill Ackman managing your money, then you can just buy some Pershing Square. Also, as well, if we go over Ackman's track record, so this is through Pershing Square, but 2005 to 2019, this runs from, his average return has been 12.59% a year, and that compares to 6.75% for the S&P in the same period. So on average, he's beat the S&P by 5.84% a year. That includes the 2019 results, which had a 58% return. But then in 2020, he actually had an 85% return. So he seems to know what he's doing. They don't give a huge amount of information. They just talk about, because it just holds American companies, basically. The net asset value at the close of play on 25th of May, 2021 was $48.93 per share, or £34.6, and the year-to-date performance was 7.9%. And in the latest quarter, the portfolio value increased by 4.5%. So the number of positions, and I'm just getting most of this straight from a Seeking Alpha article now, but the number of positions has remained steady at 7. The portfolio remains heavily concentrated with a few huge bets. The top 3 positions account for 52% of the total portfolio value, which is Lowe's companies, Hilton Worldwide Holdings, and Restaurant Brands. The company's taken new stakes in Domino's Pizza, and that's the US listed one rather than the UK one. So this is a 7% position, which was established in the quarter, and they have a 5.3% ownership stake in the business. They have disposed of their stake in Starbucks, which was 11% of the portfolio. They have increased the stake in Howard Hughes Corporation, which basically, my understanding is it just owns a lot of land now. And their beneficial ownership is 25% of that business. They've decreased their stake in Lowe's companies, which is still the largest position at 22% of the portfolio. However, the last 2 quarters have both seen some minor trimming. They've decreased the stake slightly in Hilton Worldwide Holdings, which is about a 15% of the portfolio. And there was minor trimming in the last 3 quarters. And they've also slightly decreased the stakes in Restaurant Brands, which again is about 15% of the portfolio. Chipotle Mexican Grill, which is about 14.75% of the portfolio, and Agilent Technologies, which is about 4% of the portfolio. How would you feel about the 7 holdings and the large position sizes?
I suppose that's the thing. It is very concentrated, and I guess you'd expect most managers would have at least 30 positions, do you think?
I think that's probably about the norm, 25, 30, isn't it?
Yeah. I mean, some might have, 100, but so I suppose it's extremely concentrated. I don't know what his investment style is. Does he have any sort of description of himself or how he views investing?
He chops and changes a lot, I think. I know he used to have quite a large Berkshire position and got rid of that. He's had other companies throughout the years. He's also shorted stuff as well. He was quite well known. He did like a big short of the company Herbalife. And then another investing billionaire, Carl Icahn, decided to go long on it at the same time.
Okay.
So there's a good Netflix documentary actually about it.
Oh, really? Oh, interesting.
Called Betting on Zero, but he lost quite badly on that short.
Okay, interesting. And I suppose from a lot of the companies that you mentioned, I guess there's a sort of maybe a quality theme there.
Yeah, I mean, Chipotle and Domino's particularly stand out there. Well, Starbucks as well. I know it's gone, but
that
definitely a quality
again,
business.
yeah.
He's got a lot of exposure to like restaurants. So he's got restaurant brands, Chipotle, which is 15%, Chipotle Mexican Grill, nearly 15%, the new steak at Domino's of 7%.
Yeah, I suppose obviously overweight in sort of, I suppose, food. And I guess the Domino's obviously is takeaway. The rest is sort of sit in, or certainly more so. I mean, they may have sort of takeaway offerings now. So I'm not sure. Do you think he sees value at the moment in those areas given COVID? Was he pretty heavily exposed a year or so ago, 18 months ago?
So it looks like he's had restaurant brands for going back to at least 2017. Chipotle goes back to 2016. And obviously, Domino's is new, but that's 37% of the portfolio. I guess if you were like having Pershing as a part of your portfolio, maybe you'd be more comfortable. But I wouldn't be that comfortable having 30% exposure to basically food, isn't it?
Yeah.
Anyway,
do you have any further thoughts on him?
The only other thing I was going to mention is it does have a dividend yield of 1.21%, and it's trading at a discount to the value of the assets of 24.59%. But it historically trades at a discount to the net asset value, so you shouldn't buy it thinking it's going to go up like 30%. So that it trades at the value of the net assets, because that's probably not going to happen.
It's probably yeah.
Right, shall we move on to British Land Co?
Yeah, so British Land, it's one of the UK's largest REITs on the FTSE 100, announced their full year results, and underlying profits stood at 201 million, which was down 34% on the previous year, and their portfolio value fell 10.8% year to year to 9.1 billion. And that was driven by a decline in retail property valuations, and for the year gone, they've only collected about 83% of their rents. Within the estimated value of the group's retail portfolio, falling 24.7%, it's now estimated to be worth 2.6 billion, with higher vacancies as tenants are facing CVAs or administrators. Occupancy stands at 94.1%, which is down from 95.7% in the previous year. However, it's only 90.6% if the current units currently in administration are considered vacant. And the group's collected 71% of the 2021 retail rents. Within the retail portfolio, the equivalent of 1.7 million square feet of renewals has been completed for the year, and average prices for those completions were down 19% compared with the previous year. The weighted average of unexpired lease terms has fallen from 5.9 years to 5.1 years. Encouragingly, footfall and sales have recovered well since the reopening at 88.3% and 104.1% of pre-pandemic levels. In the offices part of the business, the portfolio fell 3.8% to £6 billion. Occupancy was down 97.3% to 94.1%, with rental collections in that part of the business at 99%. Lettings and rentals were down from 946,000 to 395,000 this year, with the weighted average unexpired lease term falling from 5.7 to 5.5 years. Over the year, British Land completed £1.2 billion worth of disposals, including 643 million of offices and 556 million of retail, with average sales 6.2% ahead of book value. In terms of acquisitions, the group made 284 million in acquisitions in out-of-town retail parks, and capital and development spend came in at 60 million and 129 million respectively. Net debt fell 23.8% to 2.9 billion, and that was as a result of asset sales, with loan to value of 32%, which was down from 34% last year. So I suppose the results could have been much worse, but obviously not good. Encouragingly, I suppose the signs that the footfall and sales are recovering well, albeit still below the pre-COVID levels. And I don't know, in my view, I suppose I probably think that there's a strong case for the retail parks and shopping centres for that sort of experience. You get the retail experience, even if they have to adapt and I suppose the less certain area of the business is the offices and how much you're going to see the return of workers to the office, given that a lot of companies have found it quite efficient for the workers to work from home and probably their preference for it, given the savings, especially if you consider commuting into central London. I suppose these are those reservations perhaps reflect in the price. The price to book is 0.69, which compares with a 10-year average of 0.79, and it's still got a decent dividend, which the yield of which is about 3.9% at the moment. Sam, did you have any thoughts on British Land?
I guess on the surface, I agree with your comments that the results could have been worse, and there's some cause for optimism. But I think what's probably the most concerning thing for me in those results is that where they've had to renew leases on the retail side, the average price has dropped 19%.
Yeah.
So how much of a problem is that going to be? Is that like as more stuff comes up for renewal, and will that continue? That's concerning. I think given that and the current situation, I'd expect it to trade at more of a discount to the 10-year average.
Yeah, I suppose it has seen since the autumn and since we saw the vaccine come out, the share price has improved a lot.
I've not actually followed the share price. I did own it last time we talked about it in the autumn. And then I can't remember when, but I got rid of it at some point.
I think it's up about 50% or 55% since September.
So there's a big spike, isn't there, on the share chart for last year?
Yeah.
I definitely sold after that spike, because when we covered it on the show, it must have been it had to have been after September, because we hadn't started the podcast at that point. So I don't know when I actually sold it, but I wouldn't be happy owning it. And that's why I sold it, actually. I bought it because it was quite cheap, and then I just had a look at my portfolio and I just thought, do I actually really want to own that?
And what were your reasons for selling? Was it?
It was just I didn't like the business. I bought it because it was cheap, but it was a business that I didn't like. And I just thought I'd rather own a business that I do like. So I just got rid of it.
And did you buy it pre-COVID or after?
I bought it post-COVID.
I see. Okay.
So I bought it sometime in the summer. I don't know, I probably got about 25-30% on it. But to be honest, if it had been flat or down slightly, I would have sold it at the same point anyway. I was just selling it because I thought about it and I just thought I didn't want it. I'm not very optimistic about it. I think there's a lot of question marks, and I don't feel like those question marks are necessarily reflected in the price.
Okay. And what do you think about, well, first of all, the retail side of the business, and then secondly, the offices?
I think retail is the biggest problem because, as shown by those results, they can't negotiate at the same level. And once they start dropping prices, if other people are coming to renegotiate, or it's the same different leases for the same customers potentially that are being renegotiated, that could become the norm, that they want to pay the lower prices, or that it's just not worth as much to them, especially if foot traffic doesn't recover in the same way. Offices, I think it's slightly harder, but I think with working from home and more flexible working spaces popping up, again, I'm not sure I'm that optimistic about the long-term future of those as well. I don't think they're going to disappear by any stretch, but again, it wouldn't surprise me if they're unable to charge the same level of rents. So I'm not particularly optimistic about either side of the business. What about you?
Yeah, I mean, obviously, I suppose the fact that they haven't been able to negotiate as hard and get the same rents that they were previously with the retail is concerning. But I think the offices would be the thing that I'd be particularly worried about, whether that trend is a longer term one that's not going to return to pre-COVID levels, where I suppose at least you've seen the footfall. So a first, I suppose, encouraging sign with the retail that may be returning to something that we saw pre-COVID. So yeah, overall, I don't like the business, and the results weren't good. I suppose we weren't expecting them to be good, and when we've looked at the sort of statements before, they haven't been, post-COVID certainly haven't been positive, but it's just, I suppose, looking for those signs that they are improving or that things are recovering. With that, I guess that's why you've seen the share price rise so much over the last 6 months.
I guess on the flip side, these results could have been worse. That's maybe
yeah.
The share
we have covered it before, and they were worse. I mean, these
There
are
you were, yeah.
so. But yeah, I don't know how much of a discount it would have to be before I'd be interested, but certainly not right now, and probably not in the near future. I wouldn't have thought.
No. Should we move on to Luceco?
Yeah.
Yeah, so Luceco, not a business I was familiar with. It was actually a request. So they've not, I don't think they've reported any results this week. So we're going back and looking at the full year results, which came out a couple of months ago. It was a request from Noob Investor on Twitter. So it's N00B_investor. But yeah, he requested we have a look at it. So we're looking at the last results, which is the full year results. So we got a little presentation on the website for anyone who wants to understand what the business is. So I would check that out, but I'm just going to be reading from this and explaining what the company is. So they're a designer and manufacturer of electrical products, and they do wiring, accessories, LED lighting, and portable power. Their primary market's the UK, but they have recently started expanding internationally. They have operations in the UK, China, and sales offices in Spain, Germany, UAE, Mexico, Hong Kong, and South Africa, and 2,000 employees worldwide. Wiring accessories makes up 46% of group revenue, and they have a 15% market share, putting them in the number 2 position in the UK market. Their commercial power and accessories side of the business is more recently established, so they've not given any information for that. Combined, the Kingfisher and the Luceco LED lighting is 28% of group revenue, and the Kingfisher LED lighting is actually 15% market share, which puts them in the number 4 spot. Their portable power side of the business makes up 26% of group revenue, and they have a 40% market share, putting them in the number 1 spot. So we're looking at their full year results, which came out at the end of March, and revenue was up 2.4% to 176 million. Gross profit margin was up 2.3 percentage points to 39.8%. Operating profit was up 46.5% to 29.6 million. Operating margin percentage was up 5.1 percentage points to 16.8%. Profit before tax was up 96.5% to 33.6 million. Profit after tax was up 113% to 27.9 million. And the earnings per share was up 116.9% to 18p per share. So they've highlighted that they outperformed the UK market, and they've said that that was driven by gross margin expansion and diligent overhead control. They highlighted the net debt reduced by 9.1 million to 18.3 million and leverage by 0.6x to 0.5x of adjusted EBITDA, providing capacity for future investment and growth. And there were a few things in the slides as well. So they said they expect their adjusted operating margin percentage to be similar in 2021 to the 2020 level. So basically, they're saying that where we've seen that reduction in cost and the increase in margin and how well that's flowed through into the profit, they said they're expecting that to continue. In terms of the revenues per channel, they've said that for the year, DIY was up 9%, pure play online was up 26%, and grocers was down 30%. They highlighted significant market outperformance in the wiring accessories segment, where the market declined by 6%, but their sales grew by 16%. So per segment, wiring accessories revenue was up 16%, and that has an operating margin of 28.3% and total revenue of 81.3 million. LED lighting revenue was down 8.7% to 49.5 million, and the operating margin is 5.7%. Portable power revenue was down 5% to 45.4 million, and operating margin is 9.3%. In terms of the financials, from 2016 to 2020 inclusive, revenue has increased from 133 million to 176 million, and earnings per share has increased from 4.6p per share to 18p per share in that time frame.
And what's the valuation of the company at the moment? Because they're certainly impressive results.
So they have a market cap of 553 million and trade at a PE ratio of 22.19, and they have a dividend yield of 2.3%. Thoughts on Luceco?
Well, certainly, I mean, they're impressive numbers. I can't pretend I know anything about the industry, but it doesn't strike me as particularly expensive given the growth that they've had. One thing that I did wonder about is that commodity prices have been going up a lot recently, and certainly over the last 6 months. Is that something that's hitting Luceco's bottom line?
I don't know is the answer. So they've said in the results they expect to keep the same operating margin percentage. So to me, that suggests it's either not affecting them or they think they'll be able to pass it on in the form of price increases.
Yeah.
But specifically, I'm not actually sure on the impact.
No.
I agree it looks cheap at a PE of 22. I think the reason probably is they're pretty established in the portable power market, where they've got a 40% market share. And then for a lot of the other ones, they are very, very competitive markets, I think. Like if you're getting wiring accessories or LED lighting, are you bothered if it's a Luceco light?
Yeah.
I think the answer is probably
it's cost
no.
sensitive. Yeah.
Yeah, so it's I think they've done a fantastic job, but I think the reason it's so cheap is because you can't assume that growth will continue.
Yeah.
And for example, they've gone into where they've just moved into the commercial power and accessories markets. There's no guarantee they'll be successful and be able to command a large market share. So I guess that's why it's quite reasonably priced. But I suppose if they're expecting their operating margins to stay where they are, they don't need to grow that much anyway. At P of 22 for a business with that track record, I think it's pretty reasonable. The only thing is, for me, it's probably just a bit similar to you. It's not an industry I understand. It's very, very competitive. So I'd say it looks interesting. I do like it, but it's probably just going to go in the too hard pile. What about you?
You might like something with a bit more of a moat.
Exactly, yeah. Because, if someone else comes in and is willing to, charge £1 less per light. If I walk into B&Q and I'm looking for a light, I'm not looking for a Luceco light. And I think that
No.
that's always going to be the case. And they're not some Goliath where they've got this incredible, or as far as from what I've seen, they're not this Goliath where they've just got such a dominant position in the market that they're the lowest cost operator. They are one of a number of operators in every market, but it does look like a good business.
So would it make the watch list?
Possibly would, actually. I do like it, but I'd be surprised if I were to buy it. But it is an interesting business.
And what did we say the market cap on that was?
553 million.
Okay, so it's fairly small compared with most of the companies that we cover on the podcast.
Yeah, and they've talked about the size of the markets they're in as well, actually. So in the wiring accessories markets, where they've currently got a 15% market share, they've estimated that market's worth 500 million. Commercial power and accessories, they estimate that where they've recently moved into, they estimate that market's worth 200 million. For the Luceco LED lighting, where they've got 4% market share, they estimate that market's worth 700 million. Kingfisher LED lighting, where they've got a 15% market share, they estimate that market's worth 100 million. Portable power, 40% market share, they estimate that market's worth 100 million. So when they're currently making, a year? 29.6 million per year operating profit on 176 million of revenue, market cap of 553 million, they do have room to grow. Yeah, with the size of those markets.
Should we move on to our next company, which I suppose would we describe it as a lockdown winner? Pets at Home. They had their full year results out, with the group announcing that full year revenue was up 8.7% to £1.1 billion. And that reflects growth in the retail, particularly through the website and also through the vet groups part of the business. Underlying pre-tax profit stood at 87.5 million, which includes the repayment of the business rates relief. And that was better than the guidance, but 6.4% down on last year. If we break those results down, in the retail division, like-for-like sales growth was 8.8%, and that represented a 2.7% increase in in-store sales and a 71.7% increase in online sales. Overall, online sales make up 15.8% of all retail sales, compared with only 10% in the previous year. Revenue stood at £1 billion, with a 6.6% increase in food sales and 15% increase in accessories. And for reference, 54% of revenue in the retail division comes from food, but margins on the food were under pressure And along with higher costs associated with COVID, meant that operating profit was down from £89.3 million in the previous year to £79.5 million this year. In terms of the vet group, like-for-like sales rose 7.9% to £123 million, and fee income from the joint venture practices rose 6.3% to £57 million. The group disposed of Specialist Group for £80 million. Operating profit in the vet group division was 36 million, which was 17.6% higher than the previous year. And that was due to higher sales, lower costs, and the disposals. And Pets at Home, they have a scheme, sort of VIP member scheme, which is similar to Tesco's Club Cards, which now has 6.2 million members, which is a 9% increase from the previous year. And the VIP members that shop in more than one of Pets at Home channels is up 10%, which is over a quarter of those VIP members. Puppy and Kitten Club membership rose just over 60%, and those customers typically spend about a third more than non-members each year. Underlying free cash flow fell from 67.4 million from 89.6 million, and that fall reflects a £22.1 million increase in inventory due to restocking after the panic buying in the early lockdowns. And the sale of the Specialist Group, proceeds from that helped swing the group from an £85.9 million net debt position to a £1.4 million position net cash. The group expects full year underlying pre-tax profit going forward of 120 to 130 million. The dividend was increased to a total of 8p per share for the year, which is a 10% increase on the previous year. And on these results, the shares were up 2%. At the moment, the price to earnings stands at 25.2, compared with an average since listing in 2014 of 15.5, and the prospective dividend yield is just under 2%. Sam, what are your thoughts on Pets at Home and these results?
I mean, last time we covered it on the show, we were quite pessimistic. The results were not as good as these ones. I think it's a very, very good year for them. I wouldn't have expected it to be a good year, given that a lot of the revenue comes from like destination shopping, so grooming and the vet services, and there'd have been less people going to the stores. So I wouldn't have necessarily said this will be an instant lockdown winner. But yeah, these are very, very good results. I think the main issue for me is that you've now got to pay up for it.
Yeah.
A P of 25.2, I think it looks quite expensive.
Yeah. No, I would tend to agree. I didn't like the business much initially. I think I'm beginning to appreciate it more, and probably beginning to appreciate the various channels that it has, and maybe the use of the VIP, the sort of almost the club card equivalent, and how they're able to grow the revenue in higher margin parts of the business. But it's still, I mean, I think it was of the retail sales, 54% came from food. And we've mentioned it before in terms of food for pets and that being incredibly price sensitive. And, you know, bigger competitors like Amazon, I think you said with your own dog, you tend to buy from Amazon or basically wherever is cheapest. But there are maybe some more factors in that, you know, that you might like to try out the products, and that they've got sort of the veterinary services within the branches that perhaps I hadn't appreciated as much or given as much weight to previously as I would now. But yeah, it's overall, I think they were pretty good results. Better, yeah, like you say, better than the last set. But that's now, it is reflected in the price.
Yeah, and I don't think that pet ownership is going to continue to rise 8% per year.
Well, yeah, I suppose that's sort of. I suppose after or during lockdowns, during the pandemic, it sort of increased massively and possibly peak pet ownership.
Yeah, and it's so the revenue was up 8.7%. But that's pretty much in line with the increase in pet ownership. So I'm not necessarily sure there's anything to suggest that growth's going to continue. All I think you can really hope for is that more of the sales move online, and they're moving online to pets at home rather than somewhere like Amazon. But yeah, these are very impressive results, but I wouldn't want to pay 25 times earnings for this company.
Yeah. No, I think I'd agree with you there.
Right, should we move on to AJ Bell?
Yeah, so AJ Bell, do you want to lead on this one? But we've covered it before on the show. It's one of the big DIY online stockbrokers.
Yes, so the AJ Bell have come out with their half-year results. Revenue was up 21% to 73.9 million. Profit before tax was up 39% to 31.6 million. Profit before tax margin was up 5.6 percentage points to 42.8%. Total customers increased by a record 51,492 in the period, up 32% over the last 12 months and up 17% in the first half of the current financial year. Total net inflows of 3.1 billion were driven by platform net inflows of 3.3 billion. Assets under administration was up 35% over the last 12 months and 15% in the first half of the current financial year, closing at 65.2 billion. Assets under management was up 180% in the last 12 months and 75% in the current financial year, closing at 1.4 billion. Customer retention rate remained high at 94.8%, and that was down slightly from 95.5% in the 2020 year. The number of retail customers was up 17% to 346,797. There were also quite a few interesting points in the slides. It talks about their acquisition of AdAlpha, which they've said is a development of a simplified mobile-led platform service to broaden their offering to financial advisors, helping them to serve a wider range of clients. They highlighted that the UK platform market continues to grow, with total assets held on platforms now exceeding 800 billion. So the UK platform market grew by 11% per year between 2015 and 2020, and the AJ Bell platform assets under administration grew by 23% per year over the same period. Their retail side of the business is actually split between advised and direct to customer. So whereas Hargreaves is all direct to customer, they will actually give you advice and they'll manage the assets for you. So direct to customer was up 24% to 213,767, and that has assets under administration of 16.9 billion. Average customer is 43 years old and has 79k of assets. The advised side of the business, customers were up 9% to 118,509. Assets under administration were up 13% to 41.1 billion. Average customer is 56 years old and has 347k of assets. They highlighted that for the direct-to-consumer side of the business, the average customer acquired in the half was 38 compared to the average of 43. So it was similar to what we saw when we looked at Hargreaves a couple of months ago. They're attracting younger people to the platform, which is obviously quite good. In terms of the valuation, they are trading at a market cap of 1.74 billion. And I'll just work out the PE because the one that's showing it won't actually have those results in. And they're probably trading at a PE of about 37. I thought it'd be quite useful because Hargreaves haven't come out with their results yet for the 6 months, but they have come out with a trading statement. So I won't go into it in too much detail because we will almost certainly cover these results in full. But Hargreaves announced assets under administration of 132.9 billion for the period, which was up 28% year to date. Hargreaves is over twice the size, and the growth is actually higher in assets under administration, despite being bigger. And Hargreaves have 1.622 million active clients now, with net new active clients up 126,000 in the period. So I think the number of clients has gone up by a lower proportion, but I mean, they've added 126,000. AJ Bell's on the direct to consumer side only got 213,000 in total. Year-to-date revenue for Hargreaves was 532 million, which was up 19. And that compares to revenue of 73.9 million for AJ Bell, which was up 21%. Oh, and as well, Hargreaves still trades at a PE of 28 and a market cap of 7.86. So for me, Hargreaves is bigger. There's not a huge amount in it, but I'd say given the size Hargreaves already has, those results were more impressive, and it's at a lower valuation. So although I like AJ Bell and I like the industry, if I wanted to play on it, which I do, and I would buy Hargreaves, which is what I already own. What are your thoughts on AJ Bell, these results, and the comparison to Hargreaves?
I think it would be similar on that basis, would also be buying Hargreaves. In terms of the shape of the business, you said that Hargreaves, is it right that they don't have the wealth management?
Yeah, they won't manage your money for you. They'll offer some funds and stuff, but they don't really have an advisory side of the business like AJ Bell do. Whereas AJ Bell, they will actually take your money and manage it.
What do you think of that? Do you think that's something that Hargreaves should go into, or do you think that that's something that they're better staying out of? Because I suppose that's one, apart from the valuation of the business, that's one thing that does differentiate them.
Yeah, and it is an opportunity, but I think as a share, when they're doing so well at the direct consumer, given how that market's growing, it must be taking market share from the advisory side of wealth management. Yeah. I would rather see them continue to just focus entirely on that, because there's still, they've got assets under administration. I'll just find it. They've got assets under administration of 132 billion. The total UK platform market's worth over 800 billion. So even Hargreaves, there's still a lot of assets for them to get. And I'd rather they focused on that. And then maybe, if the market stopped growing as much, if they've got like a much more dominant position, then look at other stuff. But I'd much rather their focus was on the direct consumer. What are your thoughts?
No, it sounds like that's what they're good at, and that's what they've had such success with over the years. They're the market leader. Yeah. Why would you change that strategy?
Yeah. Exactly. And then if you find yourself where you're just the dominant player or the market's not growing as much, then start branching out. But when there's so much going on in the current market, I don't think they need the distraction, to be honest. And it's going to be lower margin anyway.
Yeah. No, that's right.
It's still very impressive results from AJ Bell. I don't want to take away from that. It's just not as good a business as it's kind of like when we look at what's it called? That the one that has Imperial the soap, Imperial Leather or whatever it is.
Oh, Peter Cousins.
Yeah, it's like when we look at that, and I think we looked at that a few months ago, and the conclusion was, well, it looks decent, but it's not as good as Unilever. I feel a similar way with AJ Bell.
But it's further down on your watch list. I don't delete it, but I just check in on it periodically and see what the results are like. And
yeah, I do like the business, and there is a level at which I would be quite interested in it, I think, but certainly I would expect it to trade at I guess maybe slightly higher because it's a smaller business, but I wouldn't expect the disparity between the valuation of AJ Bell and Hargreaves to be so great, given the numbers that Hargreaves is still putting up.
Yeah. So Hargreaves would be a pick at the moment from those two.
And I do own it, as mentioned anyway. What about you? Have you ever thought of getting some Hargreaves? Because it is a very impressive business.
Potentially. I bought Rightmove relatively recently, and Hargreaves is probably that other UK listed company that I don't own, but I quite like at the moment. So possibly, we'll see.
Maybe we'll see you dip your toe in the future.
Yeah, exactly. Okay, so in terms of the US company of the week, we've got Nvidia. So Nvidia, certainly, if you're a teenage boy, you've probably come across it in gaming. It's the world's largest graphics card manufacturer, but it also does manufactures computer chips more generally. It's had first quarter results. So they announced that their gaming business reported sales of $2.8 billion, which is up 106% year on year. And that reflects the increase of sales of the GeForce GPUs, graphics processing unit, for desktops, laptops, and consoles. They reported that the division continued to benefit from the demand for ray tracing enabled RTX 30 series. And the group also believes that the division benefited from the cryptocurrency mining demand, although it's very hard to estimate exactly what that was. Center revenues were up 79% year on year to $2 billion, and that reflects the acquisition of Mellanox, as well as the ramp up in NVIDIA Ampere GPU architecture products to the large commercial consumers. And the sales in professional visualization were up 21% to $372 million, with strong growth in both desktop and notebook workstations. Automotive sales actually fell 1% to $154 million, whilst the other OEM and other benefited from the increased crypto demand, with sales up 137% to $327 million. And cryptocurrency mining processes accounted for about $155 million of revenue. Free cash flow for the quarter was up $1.56 billion from $754 million a year ago, and operating cash flows more than offsets at near 100% increase in capital expenditure. Net cash for the end of the quarter stood at $5.7 billion, up from $4.6 billion at the end of January, and management expect revenue to be around $6.3 billion in the second quarter, with operating expenses of about $1.76 billion, capital expenditure of between $300 and $325 million. One of the interesting things that's been in the news a lot about Nvidia is buying the British, or formerly British company ARM, and that's currently with SoftBank over in Japan at the moment, and they'd be buying this, well, ARM being essentially a company that does chip design for mobile processing units, in most commonly in laptops, tablets, but also that sort of Internet of Things. It's unclear exactly how much that will cost, but it looks like they're going to, or Nvidia are planning on paying for it by issuing new shares and diluting existing shareholders. In terms of its valuation at the moment, it's, well, definitely not cheap. It's got a price to earnings of 44.2. That compares with an already pricey 10-year average price to earnings of 27.8. I think it's got a tiny dividend yield, but obviously it's a growth company, so you wouldn't be expecting much from it in terms of dividends. But Sam, I mean, with revenues of 5.7 billion, which is up 87% year on year, what do you think of Nvidia, and do you think it justifies that price?
I think if it continues to deliver those kinds of numbers, and yeah, I think they are fantastic results. It's not cheap, but you wouldn't expect that for a company with those kinds of results. My concern is just the size of it. But I mean, it is a very, very impressive business. It is interesting as well, actually. When we did the fantasy portfolio episode, this was off air, but you wanted Nvidia in, and I talked you out of it. And it's up 21% since then, so maybe it should have gone in.
Yeah.
But no, it's a very impressive results. It's not cheap, but for a company of those figures, you wouldn't expect it to be.
No, I think the difficulty is with a company like that. I mean, you appreciate that it's sort of very good quality, but the price for the growth is sort of factored into that. And I mean, with the fantasy portfolio, it's a company that's it was easy to sort of suggest it, but it would be much more difficult if you're putting your own money into actually buying it.
Yeah, I wouldn't.
You'd have to be a lot braver.
Current valuation, but that's mainly due to its size.
Yeah, I mean, what's the market cap? I mean, it's well over 250 billion, isn't it?
It is, yeah. I think it's like 300 or 400. It's $404 billion. So, of the 6 companies we've talked about this week, Pershing Square, British Land Co, Luceco, Pets at Home, AJ Bell, Nvidia. If you had to buy one, which one would it be?
Of those, it would probably be AJ Bell, actually.
I'd probably
go. I mean, obviously, it's of those. I might have a preference for Hargreaves, but it's not of the list of companies.
No.
Not an option.
I'd probably go with Luceco, but that's if I didn't own Hargreaves, I'd have more of a decision between Luceco and AJ Bell. I'd possibly still end up going with Luceco just because I think AJ Bell's quite pricey given the alternatives.
Yeah, fair enough. Okay. Well, thank you very much for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.